Hello, everyone. Welcome to another learning on investing. As we all know, investing is one of the best ways for us to build wealth over the long run. However, some investors often focus on the returns alone rather than on the risks involving their investments, and that could make costly mistakes. Well, as we all know, mistakes are part of the learning process, whether we talk about life in general or business or economy or investments. Knowing those mistakes beforehand can help us avoid committing them, especially if those mistakes involve losing our hard earned money, right? But the good news is most of our mistakes can be avoided through awareness and education. So once we recognize our mistakes, learn from it, we can take steps to improve and eventually achieve our financial goals someday. So here are some of the common investing mistakes to avoid using the Simpsons way as my illustration. Well, as you all know, The Simpsons is an American animated sitcom that became popular in the 1990s. So I grew up watching this comedy animated series depicting the life of a typical American family, The Simpsons. All right, so let's proceed. What are the common investing mistakes and what we can do to avoid them? Number one, lack of financial planning. There's a saying that failing to plan is planning to fail. And some people would rather spend more time planning for occasions in their life or planning a dream vacation instead of planning for their future. It's very important that we set our financial goals and time frame and develop a systematic or automatic saving and investing plan. Budgeting is one, and developing money management skills. So, if we could avoid impulse buying, overspending, or making unwise decisions. So, we have to start financial planning. Okay, next is miscalculating risk tolerance. Any legal investment comes with risk. And the risk tolerance level of individuals would depend on their profile, their age, source of income, lifestyle, personality, financial goals, time frame. There is no such thing as a one size fits all type of investment. What works for me may not necessarily work for you. So the success of an investor lies in finding a trade-off or a balance between risk and return. Next is the lack of savings and emergency funds. So during this time, this pandemic, I believe that most Filipinos have realized the importance of setting up their emergency fund and having sufficient savings. So we have to set up our emergency fund for sickness, calamities, accidents, business failures, or shutdown. Next is jumping on the bandwagon. It means joining the crowd and following what everybody else is doing. So when they buy shares of stocks, you also buy. So never invest based on rumors, hot tips, or stories, future predictions of people, or expectations of other people. You have to stick to your core, have the conviction to stick to your financial goals and your time frame. Another mistake of investors is the inability to have leverage. So some people over diversify, meaning they put too many eggs in one basket or spread their money into different type of investment vehicles, thereby minimizing their returns. There are also people who under diversify, which means to say they put all their money in just one investment vehicle, which exposes them to greater risk. So having enough borrowed capital to pursue a certain investment endeavor will do. So it is important that we assess how much is enough as our leverage. Another common investing mistake is what we call over-diversification. It is putting too many eggs in one basket, which of course minimizes our returns instead of maximizing our returns. So diversify so you can minimize the risk of losing your money, but not over diversify to the point that you can no longer monitor your investments and you are incurring too much transaction cost for over diversifying. Next is wrong timing of the market. All right, it's not knowing when to buy and when to sell your shares of stocks. So the recommendation is buy low when the stock prices are low and sell high when the stock prices are high. However, you cannot time the market. Even stock experts can never predict exactly when prices would go up and down and by how much. So know when is the right time to buy and exit the market to cut losses is very important. So time, not timing, is your greatest ally in building wealth. An investor as a strategy would invest regularly and consistently in any market situation. Another mistake often committed by investors, it's the lack of vision and patience to stay the course. So, for example, if you have already set your financial goals, such as your retirement or college education of your future children, or down payment for your dream house, then you know for a fact that selling shares of stocks right now or redeeming them may not be the right option for you. Do not expect your investment portfolio to grow overnight. A consistent, long term investment strategy over the long run is what will build your wealth. And last but not the least, inability to cut losses. This is the inability of investors to sell at a loss when prices of stocks are going down. When prices of stocks or securities are going down, this is holding on to your investments too long instead of acting quickly to cut your losses. So you have to set a target. When is the right time for you to cut your losses? So for example, if you have set 20% as the maximum risk that you can take or maximum losses that you can take, then when your investments is losing beyond the 20% target, then it's time for you to cut losses and sell those shares of stocks. So those are just some of the common mistakes. Just always remember, never invest more than you can afford to lose. All right, so hope you have learned something from this presentation. The bottom line is if you're able to avoid those mistakes, you could make your investments pay off, earn a good return someday, and eventually take you one step closer to your financial goals. Looking forward to your success in investing. Have a great day, everyone.